above the 4.6% mark. So you saw the tech sector in the US get hit very, very strongly. It was essentially the NASDAQ, which is the top loser, while Dow continued falling. And Asia's following that Wall Street tech slump as well. Across the Asian board, you have pullbacks that has come in. You look at Hang Seng, Kospi, Nikkei. Almost any market out there is down in the red. And our implied open suggests a start which is maybe 150 to 200 odd points or thereabouts, over 200 now as we speak. And this has implications. Now, before we talk about what the trade setup would mean as yet, Alex, all eyes out on the global geopolitical situation, as you mentioned, with Israel vowing the response to Iran. And let's get in a view on that particular aspect with Pramit Pal Chaudhary. He's head of South Asia practice at Eurasia Group. Pramit, good having you. Thanks so much for taking the time. I really appreciate your time. A classic dual impact of hot inflation or inflationary data and geopolitics spiraling, maybe not out of control, but pointing towards that. What do you think is the bigger worry for risk assets currently?
Well, I think the overall picture on inflation seems reasonable, at least for India. We're expecting a good monsoon. Global fuel prices have been remarkably stable despite what's happening geopolitically. So inflation, in my view, would be a lesser concern, but that's just a personal view. But I think the bigger issue in the geopolitics is the simple uncertainty factor. We have a situation, we have won 3 wars effectively, or 2.5 wars going on right now, if you wish, Gaza being slightly separated from what is happening between Israel and Iran. And of course, the Ukraine conflict continues. And we have tensions across a large portion of the world, whether it's the Taiwan Straits, the Sino-Indian border, various other parts of the planet. But the geopolitics uncertainty factor is really what I think really rattles the markets. That it's foreign policy and international relations. The variables are basically out of government control. It's very difficult for governments to manipulate other governments, or even especially non-state actors. So in this case, we can see everybody saying they don't want a wider war. They don't want Gaza to spread. Israel doesn't want it. Iran doesn't want it. Clearly, the United States and the other major external players don't want it. India has publicly said that, of course. But circumstances may drive both sides to a war. Right now, I think the indications are this will stabilize. And I think that's one of the reasons we've seen a reasonably muted response, for example, on oil prices rising, because of assumption that this is going to be controllable. But, my favorite case is the Russian invasion of Ukraine, where everybody said that it's not going to happen, because they just assumed that Russia would carry out a minor military response, and that would be the end of it. Yeah. But in fact, it became a scale invasion.
Pramit, the question therefore arises, what is the worst case scenario? And seemingly right now across the board, as of this morning, it is risk-off sentiment. You see the dollar that has moved up, and you see equities across the board that has corrected or dropped. How would you play risk assets right now? Would you be risk-off as well? And what's the worst case scenario?
So the worst case scenario, I think, is pretty obvious. Israel decides to respond in a very heavy and public manner, which would include maybe missile strikes and airstrikes on, for example, Iran's nuclear facilities, which would be going straight to the heart of Iranian military capacity. And Iran would therefore have to respond on a larger scale to both defend itself and potentially attack Israeli military assets in Israel. The United States, partly under treaty obligations or otherwise, would have to join and defend Israel, in which case you would see Iranian and U.S. military assets getting directly involved, and Iran probably striking out at U.S. military bases in Syria, Iraq, and elsewhere, Bahrain and elsewhere, in which case you would definitely have a wider war. And then you have the problem of whether Russia and China feel that they feel obligated to help Iran, insofar as they've been trying to build this axis of resistance against the West. That's the worst case scenario. It's very hard to see that actually happening, in my view. And I think in Eurasia Group's view, America is pushing pressure on Israel to do so. What is good about the international system right now is that there is a fair amount of buffer for even a limited crisis. In other words, for example, OPEC has been cutting oil production for quite some time, so it has the capacity to produce a lot more oil if need be, if there are problems. But there's a problem, geography, which is the Straits of Hormuz can be cut off, in which case a lot of this pumped oil will have no place to go. There isn't that much fiscal capacity left, but some you can always print a bit more money, I suppose. And so, but everything points, I would argue, to almost every major power, including the two major protagonists, preferring not to extend this or have this spiral beyond a certain point. The question is degree of calibration. Can you get that calibration right?
Got it.
Whether Israel's response or Iran's response to this.
Yeah, well, remains to be seen. Difficult to predict, but I appreciate this. Pramit Pal Chaudhary, thanks so much for joining in and giving us this perspective. That's the view from Eurasia Group. Difficult to predict, and I guess there is probably no better answer than that, or no other answer than that at the current point of time. We just wait and watch, hope for peace. Well, the trade setup for the day today, independent of what happens there, the markets have shown their hand that there is going to be stress on the screen. So if you look at yesterday's session, by the way, I mean, most things ended in the red. Very few stocks or very few indices. None of the sectoral indices were in the green, by the way. Most stocks are in the red. The thing is, if you look at where the highest concentrations are, and that's my trade setup for the day today, 22,200 strike put has very large OI concentration. The markets are likely to start off lower than that, very likely. And if indeed we stay lower, and if indeed we see some bit of unwinding on those put options, that could in the second half put some more pressure. Remember, by the time Europe will open, will react to the US market pullback as well as this constant talk of developing geopolitical conflict. So I think that remains a clear and present danger. The Bank Nifty support, the Bank Nifty was amongst the worst performing indices yesterday, weightage wise, and that support is at 47,500. We are 250 points away. If it breaks that, then significantly lower positions open up on the technical side, which brings active Bank Nifty traders into action as well. What's weathering the storm thus far are commodity stocks, but it's very difficult to predict which one would be the winner. Now we know that windfall tax has been increased as well, and therefore all oil upstream comes into focus in the session today. You watch out for Reliance, watch out for ONGC, etc. Very difficult to call what will be the winner. ONGC had a fabulous day yesterday. Who knows what will happen today? And just purely, it sounds very counterintuitive, Alex, but for the last 12 months, nobody would have thought that you will call telecom as the pocket to hide in. But that certainly seems to be the case, courtesy what's happening with Vodafone. I mean, Vodafone was up 3%. Bharti was active in trade yesterday. Bharti Hexacom has been reasonably okay. Today there is a note from Jefferies, and I'll talk about that. So somehow it seems that Industar is active. So somehow telecom seems to be that pocket, which might be the place to hide. But otherwise, very difficult to predict where you can hide if you want to.
The other aspect, in my follow-up to the points that you were making on the action in the F&O space, how much of a factor will be the holiday tomorrow and the fact that in this degree of uncertainty, perhaps you don't want to carry positions?
Yes.
Right?
Yes, very much so. And therefore, there could be... So that's the other... I don't know if it's an antidote to significantly short positions or no, but yeah, you are right on specific stocks as well. A lot of people will be very cagey carrying on the positions, considering how volatile the world is, Alex. Hit the nail on the head, really.
Okay, so that's something to watch, and perhaps we can get Agam to step in and give you some of the latest cues, and that will come in just a bit. But let's talk about one other aspect before we move to the individual stocks, and I want to mention it very, very quickly, because we've seen gold prices move up over the last few weeks. I mentioned that at the start. It's currently at $2,400. And we've got a Citi note this morning that is pointing to targets of $3,000. This is unprecedented, folks. So 2,400 is 2% away from all-time highs. And we were talking about the fact that $2,450 for a troy ounce is unprecedented. We're talking about $3,000 per troy ounce over the next 6 to 18 months. Now, the context is important because, Niraj, correct me if I'm wrong, in the context of other asset classes, generally when you have dollar that is ruling the roost and is looking pretty strong, you generally see gold that doesn't do too much because it's more attractive to hold dollar assets. And treasuries, by the way, yields have moved up once again. Niraj pointed out on the 10-year it hit 4.6%. So it is actually attractive to hold US Treasury and US dollar as things stand right now. That picture could well change over the next 6 to 18 months, and perhaps that's factoring in, Niraj, in that estimate of $3,000. But it is a crazy estimate.
It is a crazy estimate, but it's also, it's just the kind of a market, Alex, wherein you rarely see all asset classes moving up at the same time, except for bonds. Equities, gold, crypto, oil, everything is moved up in tandem. So it is a bit of a crazy market out there. But yeah, risk aversion plus safe haven or combined together, plus the dollar factor that you spoke about, never know. I mean, who knows?
Richard Harris yesterday was talking about the breakout every so often for gold. It doesn't have a secular move, no asset class does. But then gold, incidentally, has periods where it has a secular up move.
No, in fact, sorry, Alex, just one last piece here, from mine at least. Sridhar Shivram of Enam Holdings has sent me this wonderful comparison of how over the last 15 years, the best investor
is
the Indian housewife.
Yes, it's in gold.
And you got to credit, because gold has given the best returns.
Yes, no doubt. In fact, that is why financial planners out there will tell you that you should hold about 10% of your portfolio in gold. We'll get to that over the course of the day. Let's talk about stocks, though. Geo Financial Services is the first on my list. It is something of a confirmation of an announcement that took place in the second quarter of FY24. It has announced that it is signed an agreement to get into a 50-50 joint venture with BlackRock and BlackRock Advisors Singapore. This is in order to form a wealth management business and a brokerage in India. This is, as I said, in line with plans that were announced last year. VST Industries is something that you should focus on. Of course, the action took place in trade yesterday. There were large trades that took place. There were as a mutual fund that was a large seller, but the buyer is actually more interesting from my perspective. Radhakishan Damani has added another 2.3 lakh shares to his kitty, about 1.5% stake, and that adds to the already 32% stake that he has. So now his stake in the company rises cumulatively to above 34%. Insulation Energy, and we were talking to the research team about this particular stock earlier today because I was curious about what the story is here. Of course, here there is an order win by its arm, and the orders to the extent of 62.4 crore rupees for solar photovoltaic modules. But I think more interesting is the price of the stock and the origin of the company. It is playing in the solar space. It was an SME IPO about 18 months ago in October of 2022, and it had an issue price of about 38 rupees. The stock is currently trading at over 1,700 rupees per share, and it's now 3,500 odd market cap company. So very interesting there, and significant updates on the half-year performance as well, which you should bear in mind. And finally, Manappuram Finance. Of course, there is a fundraise that they're contemplating, $500 million, but I think more important would be to watch the move of both Manappuram as well as the other gold loan companies. Generally, they are active when gold prices are moving quite dramatically. So that is the reason I would watch out for Manappuram.
Yeah, just keep in mind, viewers, that fundraising is via ECBs, as Alex said, so that will not have as much of an impact for sure. There is a Adani Energy Q4 update. The update is okay, but they've got smart meter orders worth $252 million in 4Q. And this space is very hot. So Adani Energy, of course, has a larger business out there. But this is an interesting one that I thought stood out. Implications for this stock as well as some of the other smart metering companies. So bear that in mind. Couple of newsmakers, as I said, watch out for the oil upstream companies because of the windfall tax. So that's to be kept in mind. Brokerage notes, two of them stood out for me. Actually, there are lots. There is, by the way, just before I get to my notes, there is HSBC, which has upped the target on Adani Ports to 1560. Watch out for that one. After Morgan Stanley note on Exide yesterday, Nomura has come out with a note on Exide today, and their target price is 485. So watch out for that one as well. And the two notes that stood out for me, which I've given as graphics as well, one of them is Jefferies on Bharti Hexacom. They've initiated with a buy rating and a target price of 1,080 on Bharti Hexacom. They say it's the best play on Indian telecom. they say it offers a way to invest in the faster growing parts of Airtel's business, which have a higher return on capital employed and better free cash flow conversion. So I think that is important. Higher ROS and better FCF conversion is a very important part. They believe that Bharti Hexacom will deliver a 16% to a 21% CAGR in revenue and EBITDA over FY24 to 27. And the growth with moderation in CapEx could result in a 40% compounded annual growth rate in free cash flow. Viewers, all of you know what CAGR is. It's the compounded annual growth rate, which means the free cash flow will grow 40% year after year after year for whatever the time period that they've estimated, which is FY24 to 27. So they value Hexacom at the same valuations as Airtel. So watch out for this one.
And the price target is interesting, 33% upside.
Yeah, 33% upside is pretty stunning. So do watch out for Hexacom. It had a good move on the day of the listing, then a bit of a quiet day yesterday, but could be interesting today. And Jefferies, in its equity strategy note, have added ONGC and 361 to their model portfolio. ONGC was up 5% yesterday. They've replaced Max Health, iPru, and Tata Steel. So these three go out. And what comes in is Apollo Hospitals, Max Life, and Hindalco. And why so? They say Max Life is available at an attractive valuation, which is a 25% discount. It has consistent growth, and it has a well-progressing Axis Bank integration. So that's the reason for Max Life. And for Hindalco, it's a bigger beneficiary of a potential global PMI recovery and China rebound. Just that last piece, Alex, wherein Jefferies is making this observation that the China recovery may not aid steel companies as much because the construction sector is muted there.
Yeah,
so the steel demand is not very strong, but manufacturing demand leads to aluminum being a better play. And therefore, Tata Steel moves out of the portfolio and Hindalco comes in. Interesting thought.
Interesting thought, yeah. And metals as a whole is an interesting space, right?
Yes, indeed.
All right.
Yeah, and there is also Varun Beverages, which has been rated a new overweighted Morgan Stanley. Yeah. Price target 1700 or thereabouts. So therefore, that could be the other interesting brokerage note.
But that's the long and short of the trade setup.
Yes, right? That's the long and short of the trade setup.
I've wanted to say that for a while.
Yeah, well, we do about an 18-20 minute trade setup. We'll try and give everything to the viewer. So yeah, that's it. But shall we cut to the editor's cut?
Yes.
For a change, Alex is sitting next to me, and I'm tossing over to Agam to try and tell our viewers an inkling into what we have today, and trust Agam to cross-question me and me to cross-question Agam on the piece that I'm bringing.
Yeah, so this is an interesting one because perhaps for the first time that I'm seeing Indian equities being compared not with another emerging market, but a developed market. And that's what we're going to talk about right now, because we're talking about growth and price to earnings ratio, which is a very interesting thing, Niraj. I think it seems like evolution is well on track for Indian markets.
Cross fingers for that. I mean, yes, we were speaking to Mark Mathews yesterday, who said that still India being clubbed as an emerging market, but at some point of time it needs to do away with that. But, here's the deal. And now I was, this is borrowed from a CLSA note.
Yeah.
Squarely borrowed from that note. But the observations are interesting. So they say they've looked at the Asia-Pacific region in entirety. And they're talking about how the core earnings growth for 2024 and 25 and what markets stand out. So if you look at the table, Agam, Korea stands head over heels over everybody in the Asia-Pacific region when it comes to core earnings growth.
Core earnings
All right,
growth,
so India is up 30, they're on the table on 24-25 calendar year.
Yeah.
India is at whatever, 14% and 14.5 or 15 odd percent. There are other markets like Taiwan, 11.9% and 26%. Look at Korea, 34.9% earnings growth estimated for 24.
Yeah.
And 34.2% for 2025.
Yeah.
The interesting thing was the P ratio for 24 and 25 for India with good earnings growth, but not the best earnings growth, is way above almost everybody else.
Right, yeah.
So India at 22.2 times and 19.3 times is head and shoulders above Taiwan, above Japan, above Australia, and even above Korea, which is the fastest growing market, at 10.8 times and 8.1 times. For a 34.35% growth, Korea is getting 10, 11 times. India, for a 13, 14% growth, is getting 22 times. I thought, I mean, there is reasons for this, of course, but I thought that really stood out for me as to how India is being valued relative to its earnings growth versus almost everybody else.
Right. And it'll be interesting to know about the kind of flows that are going into these markets, Niraj, because all said and done, at the end of the day, I still do see a lot of value in Korea, even Taiwan for that matter. And considering Taiwan is now one of those key hubs when it comes to a lot of key services which are exported around the world and needed there, these are going at a substantial discount. So while a lot of your investors and analysts say that India is an expensive market, but it deserves to be there, I would be very curious about the kind of flows that could come in here as compared to these two markets here.
Yeah, most certainly. And you are right, Agam. I mean, in some sense, the recovery in the chip business has put South Korea and Taiwan right up there in terms of flows and earnings as well. And therefore interesting. But, you know, Damien Castle, who wrote this note, the CLSA Bits and Pieces note, makes this interesting observation that Indian markets get rewarded for consistency because the growth forecast is not the highest. Forward multiples are still the highest amongst the key Asian markets because of the consistency. And for this, we take our viewers back to some historical paradigm. So if you look at 21, 22, 23, these 3 years, the core earnings growth for amongst all the markets, right? So look at Australia all over the place, good 2021, not a great 22, okay 2023. China, great 2021, not a good 22, 23. India, look at that. 33%, 0%, 33%. Even the markets that we are talking about the most, Japan, Korea, Taiwan, right? Japanese market, 1% 21, minus 10% 22, and minus 4.5% 2023. Korea, great 2021, but negative growth in 2022 and 23. And even for Taiwan, 2023 was not the best year. So I think what Damien is trying to say, and maybe that's why we are trading at the levels that we are, because since post-COVID, we've arguably had the most consistent earnings growth amongst all of the other Asian markets, and maybe which is why foreigners are willing to pay top dollar for the Indian markets. Absolutely. Consistency, I reckon, is the key because I'm actually quite shocked to know and see the numbers that Korea and Taiwan are throwing up because for 2023, they're looking at a sharp decline of around 40% for Korea and 26% decline for Taiwan. And this is in 2023 where you're completely out of the core picture as well. So, you know, the real question is that perhaps for these markets, it's possibly a little bit of a base catch-up, which is why you're possibly seeing about 25 to 35% growth on a year-on-year basis. But as far as India is concerned, there is that consistency aspect that, of course, that you're mentioning right now. Yeah, and I'm presuming, Agam, that's the thing. I don't know what your thoughts are on this, but I would presume that what CLSA note, that Bits and Pieces note is saying, probably hits the nail on the head. That when you look at data, you suddenly see that, yes, India is expensive relative to everybody else, but India has been consistent relative to everybody else. And there's just one more aspect, Niraj. I guess that while, you know, some of these Asian nations are at the forefront of technology, I reckon that India offers a more diversified gamut. We are in all the industries, and we may not be there in terms of tech, but of course, besides the demographics, we have plenty of other factors playing out in our favor at the moment. Most certainly. Okay. So, well, that's on the editor's cut, but it's a day of changes, Agan. I'm going to urge one more change. Usually, you or Alex wrap up the piece. I'm going to wrap up the piece today, if you allow me. Yes, absolutely. So I'm going to tell our viewers that do write in your comment section, borrowing a line from what both Agam and Alex say, that do write in your comment section what you think about this piece as well. And as we head into the break, hear out Prime Minister Modi as he called electoral bonds a success story. While speaking to news agency ANI, he said that everyone will regret scrapping off the electoral bonds. Listen in.
अब देखिए, इलेक्टोरल बॉन्ड न होते तो किस व्यवस्था में ताकत है वो ढूंढ के निकालते कि पैसा कहां से आया और कहां गया। ये तो इलेक्टोरल बॉन्ड की सक्सेस स्टोरी है कि इलेक्टोरल बॉन्ड थे तो आपको ट्रेल मिल रहा है मनी का कि किस कंपनी ने दिया, कैसे दिया, कहां दिया। अब उसमें अच्छा हुआ बुरा हुआ वो विवाद का विषय हो सकता है, इसकी चर्चा हो। मुझे जो चिंता है वो मैं ये कभी नहीं कहता हूँ निर्णय में कोई कमी नहीं होती है, निर्णय तो चर्चा कर सीखते हैं, सुधारते हैं, इसमें भी सुधार के लिए बहुत संभावना है, लेकिन आज हम पूरी तरह काले धन की तरफ देश को धकेल दिया है। और इसलिए मैं कहता हूं सब लोग पछताएंगे, जब बाद में ईमानदारी से सोचेंगे सब लोग पछताएंगे।
Welcome back to India Market Open. We are taking stock of the futures and options space in Indian equities at the moment, where it does seem like the markets have taken a step back or two, for that matter. Well, what transpired yesterday is what we are looking at the moment. Now, as far as the Nifty is concerned, we saw a decline of around 1%, but along with that, we also saw an increase in open interest towards 7%, and which also means that while Friday was a day of longs unwinding, yesterday was where we actually saw fresh shorts coming into the system. Coming down to the Bank Nifty, the picture is just a tad different, and this is where the index saw a cut of around 1.6%, and the open interest declining by around 5.3%, which means that earlier longs have now been unwound in the Bank Nifty as well. Well, moving on to the options market, at the moment, as one might expect, considering the Nifty, moved lower, we also saw a lot more writing around calls, and that would include around levels around 22,500. But when it comes to your overall open interest distribution picture, at the moment, we continue to see maximum open interest lie with the 22,700 call, followed by the 22,500 call. And on the lower end, we are now looking at, max OI shift back to the 22,000 put. Of course, today is the Fin Nifty expiry, so keeping an eye around 21,200, 21,300. But it is also the Bank Nifty weekly options expiry, since tomorrow is a trading holiday. So where we are bracing for a choppy market as far as the Bank Nifty is concerned, all the action now once again shifts back to 48,000 from 49,000 just a couple of sessions ago. That said, let's talk about stocks as well. Now, at the moment, yesterday we did see an up move for Exide, a further one in fact. So longs for Exide and MGL, shorts for Bata, Coromandel and LIC Housing Finance. And among stocks which saw unwinding, short covering for Nalco and Vodafone Idea, Metropolis Sale and Hindustan Copper see long unwinding. Let's take this conversation forward and get an expert on what they make of these markets. Well, we have Amit Goel of Amit Ventures who's joining us on the show. Amit, good morning. Thank you so much for joining in. Well, you know, it is the Bank Nifty which has in fact seen the sharper of the cuts yesterday, Amit. How are you reading these cues and what kind of option structure are you deploying here?
Hi, good morning, Agam. Yeah, Bank Nifty has been the weaker of the two in the last 2-3 trading sessions. While structurally speaking, I am still bullish on the markets and I still consider it to be a buy on dip opportunity on a long-term basis from a weekly and a monthly perspective. But as traders, we need to be aware of what the market is doing on a day-to-day basis. So I would be a little circumspect while going long here. There are two types of trades that I'm looking at in the Bank Nifty. One, if there is a mild gap down, both the scenarios are of a gap down scenario. I'm looking at if there is a mild gap down of 200-300 points, then we could initiate a put butterfly for today's expiry, wherein it is going to be a little off center. So we are looking to pin the expiry at about 47,000. So I look to sell 2 lots of 47,000 puts and buy wings of 47,800 and 47,200 puts, 1 lot each. The maximum loss in this trade works out to around 2,700 rupees, while the max profit at the pin, which is 47,000, is about 9,300. Though we would like to trail this when we are in profits of about 2,000, 2,500, and we could trail this for greater profits. This is the scenario if there is a mild gap down. But looking at the overall structure and the geopolitical scenario, we may be in for a sharper gap down. In the case of a sharper gap down, trading anything for this expiry would be a little difficult for me. The way I foresee it is, if there is going to be a sharper gap down, we might land into a technical support area, which is the Fibonacci 62% of the previous uptrend. So this also happens to be a technical number, a round number, which is 47,000 levels. So if the market lands around 47,000 and bases over there, I would like to play a slightly riskier but a counter trend trade for the next expiry, which is the 24th, wherein we would like to again initiate a butterfly itself, which is butterfly, as you know, Agam, is a limited risk, limited reward strategy, where I will look to sell 2 lots of 48,300 calls. I'm looking at the upper, the gap fill area, which we have created yesterday. So we would like to sell 2 lots of 48,300 calls and buy wings of 47,300 and 49,300 calls. Here the max loss works out to about 5,000 and the profit is about 10,000 rupees.
So two strategies proposed here as far as Amit's concerned on the Bank Nifty, and these two strategies are dependent on two different possibilities or outcomes at open. The first one is if we do see a mild decline on open as far as the Bank Nifty is concerned, that would be pertaining to today's expiry. But if we do see a sharper cut in terms of open today, in that case, you can in fact expect to deploy the second structure that Amit has mentioned in the subsequent expiry. So keep an eye on these, and of course, very well explained and comprehensively, put out as far as Amit's concerned. But Amit, let's move on and talk about stocks then. And the first one on your radar is Tech Mahindra, I believe.
Yeah, Tech Mahindra, if you've noticed, has been on a downtrend. The whole IT pack, in spite of fairly decent numbers from TCS, I would have expected that the tech space would come out of this slump, but that is not the case to be. Also, the overall market sentiment also is not supporting it. Tech Mahindra on a technical front on the daily closing has given a breakdown of in terms of my screeners. And because of that, I feel, and the next support that I see in Tech Mahindra is about 1150 odd levels, 1140, 1150, which is quite a distance away from the current market at 1220 odd levels. What I'm looking to do is I'm trying to play the downside in Tech Mahindra, and I'm trying to deploy a bearish call spread, a bear call spread, in which we would like to sell the 1240 call, one lot, and we buy an offset, which is a wing of 1260 call. The max profit here in this trade works out to about 8,000 rupees. And as I always like to do, I try to keep a rupee stop loss of about roughly about 2,000, 2,500 rupees. Now, this could also technically get negated if the high of yesterday is taken out. So if the price actually gives a reversal, then I would not wait for the losses to actually incur, and I would get out of the trade because the technical view or the technical stop is hit. There is another factor which makes me bearish in Tech Mahindra is that it has closed below the 200 EMA yesterday. So from a larger perspective, I feel there is some more pain in Tech Mahindra, and hence I would like to play the downside in this.
Okay, interesting. So that's as far as Tech Mahindra goes, playing on the downside, playing a spread here. And the final one on your radar is ONGC, Amit?
Yeah, ONGC, I mean, in the sea of red, this happens to be one very green bright spot. It has been on a tearaway run for a fair part of last 6 months. And you know, from a monthly chart perspective, I've been bullish on ONGC for a long time. It has given a breakout. It is actually playing out the inverted head and shoulder breakout from the monthly perspective. Speaking of current setup, it has given technical breakout on the daily time frame also from a triangle pattern and from a technical perspective of a Bollinger Band with good volumes. Obviously, Jeffrey is giving a buy call on this with an upside of about 40-47%. Helps matters. So I would like to play this momentum because I feel there is enough momentum left in ONGC. But I would probably wait for a slight pullback because, you know, given the market structure and the yesterday's move, possibly if we could find this lower at about from 279 at about 275, 270 levels, I could probably look at initiating a bull put spread wherein we will wait for a pullback of about at around 270, 275. Then initiate this, giving us a better RR. We will look to sell the 275 call of April expiry and buy the 270 call. 275 call is the sell, 270 is the buy. With a limited profit of about 6,000, we keep a rupee stop loss of about 3,000 rupees. The caution here is for retail investors and traders. ONGC from a derivative perspective is a fairly high beta stock, because it has a very large lot size of about 4,000 shares. So caution is advised that you please do not trade this by buying naked calls or by selling naked puts, because any adverse movement in this could impact your overall capital and overall risk in a very, very bad manner. So bullish on ONGC and bearish on Tech Mahindra are the calls.
Right. Well, a very straightforward structure as far as ONGC is concerned as well. But as Amit has mentioned, this has a relatively larger lot size, which means that we're taking a naked positions on such counters, and it ever so happens that even in terms of stock options, sometimes on the drying or the momentary drying up of liquidity, you could potentially face a loss. Of course, ONGC is not that illiquid, which is why I reckon that Amit has in fact gone ahead and ventured into giving us that strategy here. That said, these are some of the factors that you would want to keep in mind before you in fact deploy the structure that's been recommended by Amit. But Amit, on that note, taking a moment to thank you for joining us and taking us through several of these strategies in today's day of trade. Well, with that, it's back to you, Niraj.
Thanks for that, Agam. So those are the option strategies, and every day at 8:30, Agam Vakil gets you some of the best option trading ideas for the day. Now, before we move on further with the wider market, it's important to get an idea about transformers and rectifiers, because what's happened is that the Gujarat Energy Transmission Corporation, which is GETCO, has intimated the company that it has withdrawn a stop deal with the company with immediate effect, which means that transformers and rectifiers is eligible to supply to GETCO with immediate effect. Mr. Jitendra Mamtora, Chairman and whole-time Director of Transformers and Rectifiers, joins us on the phone line to explain this. Mr. Mamtora, good having you. Thanks for joining in. What does this withdrawal of the stop deal mean for transformers and rectifiers?
Our market share or our share of the total purchase of GETCO was around 25%. It was huge. And also, if you look at it, it was a business for us of around 250 to 300 crores every year. So with the withdrawal or revocation of the stop deal letter, this will go and we will be able to compete immediately in the next available tender. Okay. It's a big thing for us, and because we know the news that, it's a procedure left from our side, and it was not taken lightly by the authority of GETCO, but ultimately they realized that yes, it is a procedure left, and they have withdrawn the stop deal letter.
Was there any hiccup in terms of receivables? Has that more or less gotten ironed out, Mr. Mamtora?
See, there was a delay in the receivables, but now it is all gone. We have received almost all the money which was due, varying now 8-10 crores of rupees. We had about outstanding of 150 crores old. So we have received 140 crores around that. And now it is only 8-10 crores, which is in the process, and we should be able to get it within another week's time.
Okay, so I also, while you're speaking to us, Mr. Mamtora, want to get an update from you, because I'm seeing great numbers across the screen, notwithstanding this small hiccup that you had. Order inflow of 2,050 crore as of March 2024. Total inquiries are quite significant, over 17,000 crore. The unexecuted order book standing at 72%. The question that I have for you is, what is the focus in the new year? Is it going to be on ramping up of order wins, or are you going to focus on executing the ones that you already have?
Both. We are trying to jack up our production capacity by introducing new machineries and all that. Besides that, we are going for a backward integration, which is going to be a major issue in the coming days, because the suppliers to the transport industries are very few, and we have to take this into consideration to be able to deliver the transformers in time.
Mr. Mamtora, just one question with regards to GETCO again. So I heard you say that the annual numbers were to the tune of 250 crores, if I'm not wrong. So that's on a base of 1,000 crores. If you, what percentage of this? So it was 250 crores for you, and therefore, do you hope that FY25 you can scale up those numbers to what it used to be in the past from GETCO?
Yeah, definitely. Yeah, of course.
Okay.
Of course.
Okay, and are these orders at similar margins that you usually enjoy, Mr. Mamtora?
See, now because the market has improved, the margins are going to be better than what they used to be. It is obvious now, if you see the present trend, the prices are going up. So everyone is going to get a better price. The competition is less. And we'll be able to get better pricing and the better margin.
Okay. So last question, are you upping your soft guidance that you had given to us when you ended the year? Does this add to those numbers for FY25?
No, see, the present capacity, whatever we have, we say that we are trying to reach the capacity of or the top line of 2,000, about 2,000 crores. So that's what we are going to do. So if there are immediate requirements for the GETCO,
got it.
We'll give them the preference for that. Yeah?
Got it. Okay, slightly difficult line, but Mr. Mamtora is saying that they're sticking to the numbers, and I think during the course of the year, as things develop, maybe in a better position to tell. Maybe at the end of the Q1 numbers, when we talk to him, we'll get a better sense of how this Getco piece has moved as well. But congratulations, Mr. Mamtora, on this, and thank you so much for speaking to us today. That's transformers and rectifiers doing so well for itself in the session.
I think they talked about a top line, a goal of 2,000 crore.
Yeah.
Right? But 1,273 crore as things stand as of FY24.
Yeah, it's a very expensive stock, but the Nuvama note that I'd read when they came out with the numbers was that 2027, if they indeed expand the margins and get the numbers that they would, then while it's trading at 150 times FY24 earnings, it's trading apparently at 25 times FY27 Nuvama estimates.
Which is interesting because we talk about the power space and the kind of potential there, right? So we often talk about the Gencos and we talk about the transmission companies, but we don't talk about the transformers, right? Because you need transformers ultimately.
Most certainly, Alex. So interesting to see how the trajectory of this one is. We'll talk to our experts about transformers and rectifiers, but before we get our experts, let's get in my colleague, Kanika, who's standing by with some other stocks which are newsmakers in the session, aside of transformers and rectifiers, of course. Kanika, good morning.
Good morning, Niraj. So the first stock on my radar is TCS. The company announced a new delivery center in Londrina, Brazil, and this is to help Brazilian organizations in their technology transformation. And the focus will be on strategic areas such as digital transformation, AI, and cognitive business operations. TCS will be creating 1,600 new jobs in the southern city of Londrina over the next 5 years, and it is looking to double associates in cybersecurity, cloud, AI, automation, etc. The next stock on my radar is Cipla. The company has purchased cosmetics and personal care business undertaking of Evia Beauty for rupees 130 crore. And rupees 100 crore is contingent upon achievement of certain financial milestones in the next 3 years. The turnover of Evia Beauty in FY23 was around rupees 55 crore, and the transaction is expected to be completed within the next 60 days. The next stock on my radar is Gujarat Gas. The company is in pact with Indian Oil to expand product sales, and IOCL is providing liquid fuels at GGL outlets. IOCL is also providing automotive lubricants, greases, and specialties. The company will set up CNG facility at IOCL Coco outlets, and GGL is setting up CNG mother facility at IOCL outlets. Gujarat Gas also recently signed an MOU with BPCL, and this is for the provision of liquid fuels, for supply of automotive lubricants, and for expansion of CNG infrastructure.
Got it. All right. Thank you so much, Kanika, for laying those out for us. In fact, we've talked about quite a few stocks already, and we've talked about some of the setup that you need. But let's get you some more precise information that you can use when trade starts. And that is my cue to introduce you to the next set of guests that we have today. Rajat Bose, a research analyst, and we've also got Sunny Agarwal, who's head of fundamental equity research at SBI Cap Securities. Thank you so much to the both of you for taking the time this morning, and good morning to the both of you. Rajat, I'll start with you. It's a bit of a tough market, as Niraj was pointing out early today, not really something that will give you the clearest cues as to the direction that we're taking. A lot of chop and churn. Of course, we're looking at the likely downtick today and a gap down opening. How would you trade this market?
Well, Alex, I would, first of all, good morning and thank you for having me on your show. I would say that probably we have begun, or we have already entered into a sideways kind of movement, because the election time is already here and there is a global crisis. So initially what I'm expecting is that probably a taste of the 50-day moving average at 22,112 that might be seen today. If it were to close below that, then it would signal some kind of a weakness, because 50-day moving average has never been conclusively taken out by the bears in the recent past, at least over the last during this year. There has been only one test, and that happened recently. After that, there has been no test. So if 50-day is taken out on closing price basis, you expect more weakness. Maybe the earlier low around say 21,700 or so might be retested. But what I've seen is this, that although there can be some weakness, but it is not going to be a major fall because the money flow will continue. After some skirmishes, there will be money coming in again, either in the form of SIP or in the form of pension money or in the form of other sources, maybe sometimes FII buying. So unless 50-day is taken out, 50-day moving average is taken out decisively in the sense that it remains there for more than 1 week, then only we can think of at least a short-term downtrend setting in. And to look at this, the Bank Nifty, the Nifty, and the CNX mid-cap. Bank Nifty at one point of time, or the Nifty Junior at one point of time, fell by 1,400 points from yesterday's top. But in what percentage? This is only, say, 2%, closed at 1.68%. These are otherwise quite natural for a one-way traffic getting corrected. So this is more of a correction at this point in time. We need not get too bearish about it, at least not right now.
Yeah, certainly. And I think that it's important to put things into perspective, right? And just a few trading sessions back, we were talking about the possibility of 23,000. I think that's important to bear in mind. You've got a couple of picks as well, Rajat. Let's talk about those. You've got one buy and one sell call. What can you tell us about them?
Well, I would first like to talk about the Hindalco stock. Hindalco yesterday posted a high, and when it was posting the high, it was actually posting a spinning top. This spinning top formation, along with the kind of low and the kind of high that it posted, it shows that Hindalco, from a weekly basis as well as from a daily basis, it is sort of this uptrend is losing directionality, and it is suggesting that a course correction is very much needed. From that perspective, I expect at least the 9-day exponential moving average to be tested. 9-day exponential moving average is at 587, which is my first target. And after that, the second target will be 577. If it were to go further down, then we can see the 20-day moving average might be tested as well. So my stop loss for Hindalco will be 626.50. And the targets are 587, 577, and 562. The other stock that I have is ONGC. ONGC, to my mind, ONGC looks pretty good. So ONGC is going to give a good run on the upside even from here, because it has given a record volume yesterday. This kind of a record volume, when you are in a sideways kind of consolidation, this suggests that fresh buying interest is definitely going to come, and that will take it further up. So my targets on the upside are 295, 300, and 313. 313. These targets are, at least the last target is beyond the current range and beyond its all-time high. This is a Fibonacci target. And I have kept a stop loss at 264.70. So ONGC is a buy and Hindalco is a sell.
Some real good nuance in those observations as well, technical as they are. Rajat, thanks for that. Sunny Agarwal, great having you. And I want to start off, Sunny, by talking about upstream oil, right? ONGC yesterday doing what it did, oil prices doing what they are doing, and the windfall tax seeing an uptick of 40%, also likely to have an impact thereof today on upstream oil per se. What's your sense? And give us a sense of the windfall tax uptick that we've seen. This is twice in the last 1 month that we've seen an uptick there.
Yeah, good morning, Niraj, and thanks for having me on the show.
Yeah, definitely. I think ONGC is ultimately a play on a proxy play on crude oil prices, and if you draw basically a comparison between ONGC stock price and crude oil price, I think there is a 1:1 correlation. And every time there is a possibility of making an extra money on due to the buoyant crude oil prices, government comes in and slap the taxes so as to extract more money from the companies like ONGC. I think I would on valuation front definitely it's looking very cheap, close to 3.5 lakh crore market cap. Annually, company is making profit close to 50,000 crore, 12 to 15 rupees annual dividend per share. So I think on all the parameters it is ticking all the boxes. The only issue with ONGC is that every time there is a probability or possibility of making a handsome or extraordinary profit in some particular year, government comes and take away that profit in the form of taxes, right? So I think it's a tactical play till the time crude oil prices are moving up. I think one can continue to ride on this story of ONGC. But again, one need to be cautious of the view that crude oil prices, although it may appear to be attractive at the current juncture, in case there is an ease in concern in the Middle East belt, then probably crude oil may retrace back to $80. And again, we may see some correction over there. So again, I would not like to have it in my long-term portfolio, but definitely in my other tactical trade with a certain stop loss.
All right, Sunny, thanks so much for that view on ONGC. Do stay with us, Rajat, as well as Sunny. We have to slip into a very quick break where minutes to the start of trade. So do stay with us. Welcome back. You're watching India Market Open, and we've got Rajat Bose as well as Sunny Agarwal speaking to us. And Sunny, question for you that might be a little, that might not have an, very easy answer to give, which is this scenario about gold prices, and we're seeing it going up. We've talked about the Citi note just a short while back. In case you hadn't heard, they've given a target of $3,000 over the next 6 to 18 months. And incidentally, there was also data that came out for the fourth quarter which talked about imports of gold for India as a whole dropping quite substantially. We've got a story on the website, NDTVProfit.com, for the viewers if you want to check it out. But which companies would you watch out for? Ordinarily, one would assume that people don't go out and buy gold frenetically when the prices are at all-time highs, but then that's proven wrong in the past.
What I feel is that historical data, if you see for all the listed gold jewelry company, whenever there has been a new high we have seen on the gold prices, there has been an increase in demand or at least inquiry with all the jewelry companies. And although in terms of volume, it may come because in India, the jewelry purchase is certainly done in terms of budgets.
Suppose for a wedding, usually there is a fixed budget that somebody want to purchase jewelry worth X amount. So to that extent, maybe the volume may come down, but ultimately the value continue to remain the same. And what I believe is that all the jewelry players are in sweet spot. So yesterday, in fact, during the weekend, Senco Gold reported a very solid set of provisional update for a March quarter. And yesterday's stock reacted also to the development. I think entire consumer discretionary space, including jewelry, continue to look well, especially in a scenario when gold is expected to climb further higher from here. So I would like to ride through guys like Senco, Kalyan, Titan. So these are the few players which I feel will continue to report a healthy set of numbers. The reason being that ultimately the main two growth driver for all these jewelry companies are basically making charges, which is which usually work as a percentage of your gold prices. The moment gold prices shoot up, their making charge also moves up. So to that extent, the continuity in the margin of 8 to 10% on the gold portfolio continue to remain over there. On the other hand, gradually all these players are increasing the mix of studded jewelry, which is a relatively higher margin jewelry. So yesterday also during the Senco Gold press release, we have seen that the studded jewelry share has increased to 13% from close to 11% a year ago. And that has led to that is likely to lead to a better margin when it comes out with an audited number going forward. So I think both these growth drivers are playing up for all the players, whether it is Senco, whether it is Kalyan, whether it is Titan. And right now, looking at a valuation, I would like to bet my money on Kalyan as well as Senco.
Okay, by the way, the rupee is open as the lowest level, record lows versus the US dollar. By the way, the entire EM basket versus the dollar as well has opened at 2024 lows. So the dollar index strength is out there and to be seen, and it's certainly having its presence felt, the dollar, that is. So interesting. I doubt this has multiple implications for tech companies, really. I mean, the point of time when IT companies used to react very positively to a dollar strength and a rupee weakness was in the past. I don't think it exists anymore, but yeah, keep an eye out on the rupee for sure. Sharp pullback in the recent past. Today it's open. I mean, from a currency perspective, these are interesting dips, but yeah, I think the larger move has been in the recent past. Keep an eye out for the rupee for sure. Okay, Rajat, some of the stocks that stood out in trade yesterday, and I know you have a sell on Hindalco, but the other two that stood out for me, one of them was Exide, had a good sharp move in trade yesterday, was up about 2.23%, and Vodafone 2.5% higher, and some very strong volumes there. Rajat, can you hear me?
Yeah. Can you repeat the question?
Rajat, the question is, how do the charts of Exide and Vodafone look? Both of these stocks held out yesterday.
See, Vodafone looks pretty good. In fact, it is actually on its 200-week moving average. And this 200-week moving average was crossed last year, say around September or so, and after that it continued on the way up. Now it is being retested, so from here you can expect more buying interest. But Vodafone idea should be embarking on a fresh bullishness only when it crosses 17 to about 1750 range. And what was the other stock you mentioned?
Exide, Rajat. Rajat, I was talking about Exide, yeah.
Big move. It had a big move day before. I think it was on Friday, and after that, yesterday also, it gave a good move on the upside. So if it were to cross 425, the next target would be 437 and 445. Exide is on a roll, but then buying here, if you are actually buying for the short term, then you have to put a stop loss below the low of yesterday. That was 400. Below 400, it would become weak. But any medium-term investor getting into this should put a stop loss around, say, 370.
Okay. Medium-term investor 370, short-term investor below 400. Remember, there are 3 words of caution that have come in on Exide from Rajat and from our 2 guests yesterday about buying it at these valuations. But brokerages seem to be sanguine on Exide because yesterday we heard Morgan Stanley talk about it. Today, I think Anushi Johnson with the top 2 brokerage notes of the day. And Anushi, I believe one of them is a note on Exide.
Yes, Niraj. So I'll start off the list with the Exide one, which is by Nomura. Over here, they have retained a buy call with a target price of about 485, which showcases about a 18% upside from the current levels. Again, this is on the back of the MOU, which was signed with Hyundai and Kia. Again, with this, now the brokerage sees a huge validation for the business, EV cell business, especially going forward, which is an exciting opportunity for the company. Again, EV penetration continues to remain in focus over here with a lot of opportunity building up. If you have to look at the current 2-wheeler, 4-wheeler mix also, that has risen to about 5 to 2% respectively, which is now expected to go forward to about 25% to 20% for both 2-wheelers and 4-wheelers going forward in FY30. Also, apart from that, the brokerage is also more optimistic about the company's ability to win more orders from the other OEM sides. So if you even look at the company's mix of the PLI revenue, that stands at about 15%, which they get. But now OEMs may benefit as they pay some premium for the local sourcing. Based on this, they have also realigned their EPS estimates for FY24 and 25 and raised the base business valuation to about 18 times for FY26. Now, another stock in focus over here is Varun Beverages, where Morgan Stanley has initiated an overweighting rating with an upside of about 23%. A couple of strong reasons over here. So they expect VBL to continue with the performance that they have been showcasing, which is about 19% of revenue growth and about 24% of margins that they have been displaying. Again, now a lot of capacity expansions have been made in the under-penetrated regions of the South and West. So they are seeing some improving market share gains on those regions. Just to even give an example on this, the distribution expansion, which is about 0.4 to 0.5 million outlets per year, is one of the strongest if you have to look at the overall F&B space. Other than that, the electrification again continues to remain a good area where the company is rapidly expanding the VZ cooler reach. So this is also supporting the cold drinks category. Again, if you have to look at the valuations over here, it is the Morgan Stanley believes that it is better placed than its peers with about a 57 multiple currently at the calendar year 25 levels.
Got it. All right. Thanks so much, Anushi, for getting us all the details. Interesting update on Varun Beverages. And I'm curious about what you think, Sunny, about this particular counter. Whether you have the same view that was just described. It was up about 1.5% in trade yesterday, trading at 1400. How do you see the valuation picture playing out?
Yeah, definitely. I think we are positive on Varun Beverages, and the reason being that being a proxy play on Pepsi, and especially if I take a slightly short-term view with a scorching hit, which is across the heat wave or the heat wave which we are seeing across the India, I think the clear beneficiary is the Varun Beverages. And at the same time, one has to keep in mind that recently they have also won some contract wherein they are going to do bottling for them in South Africa territory also. So that will give another leg up. If I take a slightly longer horizon, 5 to 10 years, that's a big market that is going to unveil as far as Varun Beverages is concerned. So I think on a valuation front, definitely it's looking slightly expensive. But basically, two growth trigger which I see from a long-term perspective is entry foray into the new territory, which is Africa. And at the same time, recently they have won some contract also to make a packaging of food for the Pepsi again. So that is again a new vertical which will start contributing to the Varun Beverages maybe 2-3 years down the line. We are positive on the counter, but again, I would recommend buy on dip because slightly valuations are slightly ahead of cost.
Okay, shifting gears quite literally and talking about the auto space, and I want to talk about one particular counter. My colleague Puneet will, over the course of the day at one point, give you a picture on the overall auto industry and the outlook for the earnings which will kick off in the days ahead. But I want to talk about Ashok Leyland because interestingly, according to the estimate, Sunny, the expectation is of a highest ever EBITDA margin in the quarter gone by. And that bodes well for this CV player, but we've not seen too much action in the MNHCV space. We've seen some action, if I'm not mistaken, in the LCV space. So how does this particular counter look?
Yeah, again, we are bullish on Ashok Leyland. However, from a stock price perspective, I think the stock has not delivered since last, if my memory is right, last 6 to 12 months. The stock is hovering in the band of 160 to 180. But having said that, if I talk about MSCV volume, what I feel is that post-election, that is what we are hearing also from the management, that post-election we may see uptick in MSC, medium and heavy commercial vehicle volume. LCV continue to do well. And at the same time, with margins at a record high, I feel the stock is due for re-rating. Maybe post-election we may see the stock, and once we see MSCV volume recovering, the fair value of the business is close to 220 to 230 rupees. So it's a good opportunity to add this stock in a long-term portfolio.
Okay. Now, I'm looking at not necessarily individual stocks, but I would encourage you, Sunny, to talk about individual stocks in the spaces that I'm talking about, right? So we saw TCS results a few days back. And if I look at the year-to-date performance of the various sectors, I see that because of the recent moves particularly, but of course, the banking index as a whole has been an underperformer. It's down about 1.8%. But you've also seen an underperformance by IT as well as FMCG as PACs. From these spaces, and particularly FMCG, which has been down in the dumps because of various factors, commodity pressures, and also local players coming in, not the best cues from rural demand, which, according to you, is the play to take? And do you see any evidence that would suggest that a turnaround could occur at some point in FY25?
Yeah, I think one of the biggest trigger for FMCG industry is the expectation of the good monsoon, which I hope will be in line with the expectation starting month of June. Because ultimately, if you see, if you hear any management commentary, urban market continue to do well. It is the problem is in the rural belt, right? And in case the monsoon is normal this year, then we may see some uptick in demand from the rural belt. And then that can add a lot of kicker to the FMCG earning. At the same time, one has to keep in mind that FMCG as an industry was going through deflationary cycle since last 12 months. And now it is expected that in FY24, that cycle will get over. And to that extent, that will boost the top line for FMCG staple company. So obviously, it's a typical case of companies where there is a very low, or maybe we may say a kind of low single-digit or high single-digit earning growth, valuation north of 40x, 50x price to earning multiple, and that is the reason we are seeing an underperformance in entire FMCG staple space. But again, if I were to stick my neck out and put money in FMCG, I think Tata Consumer is the one company where I would like to bet my money. Okay. The reason being that the company is growing organically, and at the same time, they have very nicely curated strategy of growing inorganically. That is adding a kicker to the growth. So Tata Consumer is the one company which we like from FMCG staple. And another one small company which is Bajaj Consumer. So if you remember, a few years back, that was a single product almond oil, hair oil company. And during the last 2-3 years, we have seen portfolio diversification. So they have recently ventured into the skincare product. So there is a kind of diversification, and new stream has been added to the company's revenue. And what I feel is that even on valuation front, company is trading at a very reasonable 20-time price to earning multiple, very cash-free, debt-free company, and that's offer a lot of opportunity for them.
Okay, thanks for that, Sunny. Stay on. Rajat, I have 20 seconds. If I had to ask you for one top stock, just the name for today, what would the trade be? The question is for Rajat. Rajat, one top call.
I would say Kotak Bank you can look at. Kotak Bank looks pretty good. There is a possibility that it might actually move up and scale up to the recent highs around 18.
Got it. Rajat, stay on. Rajat, stay on. Let's get the markets up and running. Here's how the markets are starting off this Tuesday morning. Well, actually not as bad as the pre-open was, implied open was indicating, I must say. 0.63%, about 141 points, but down nevertheless. Bank Nifty below 47,500. That was a key support. Let's see how it behaves during the course of the day. Mid caps and small caps have taken a larger piece of the corrective move in the last couple of trading sessions for sure. we're starting off weak or almost in line with what the Sensex and the Nifty. So this screen gives you a sense, right? It's about 0.6% a piece for the mid caps, small caps, as well as the Nifty and the Sensex. Bring up the heat map and show you what's moving and what's not. Well, very little green, a lot of red. LTI Mindtree on those resignations. We didn't get a chance to talk about that, but we will post-open. Slew of resignations, 2 resignations yet again, down about 2%. TCS, Infi, so clearly IT is bearing the brunt of some selling pressure. Bajaj Finance has been under a cloud couple of days today too. Kotak Bank, which probably looks good on the charts, but starts off about 1% lower. So keep that in mind. Adani Ports and Adani Enterprises in the red as well. Most stocks are in the red, but it is no Herculean cuts except for LTI Mindtree, which is seriously seeing a gash in the session today. What is doing well? Well, a bit of a defensive bent, you have to say. Look at that. Nestle, top draw. Bharti Airtel doing okay. Titan doing okay. Divi's Lab, Cipla, Hero Moto. Clearly a bit of a defensive bent. These stocks are not moving up because of reasons per se. They're just hiding pockets, really. A lot of red though, Alex, and doesn't look like the market is ready to give up this red in a hurry because there's just no evidence of any kind of a pullback, not that any was expected.
No doubt, but I'm looking at across the screen, Niraj, at the Asian markets, and in fact, if you're talking about the major markets, Nikkei 225 down over 2% at this juncture, Shanghai down about 1.5%. In that context, it's not too much of a fall. And look at the broader markets as well, right? You have the broader markets that are currently outperforming the benchmark index right now. And the mid-cap index down only about 0.1%. The small-cap index, if I'm not mistaken, down about 0.25%. Or in fact, it's in the green. There you go. It's moved into the green right now. So I would hazard a guess to say that the market breadth is not as bad as we would have imagined that it would be. Still, let's take a look at a few stocks. We were talking about gold, so I thought let's take a check on the gold companies that we were discussing on the program not too long back. The likes of Senco Gold up in the green, Titan is up, as well as Kalyan Jewelers. Let's also look at a few brokerage calls from the morning where you have HDFC EMC, there's a JP Morgan upgrade to overweight. In fact, it's up and about. You have Bharti Hexacom, which we've discussed on the program as well, which is the top buy from Jefferies. It's up and about. And you have Exide from Nomura, which we've discussed, and we've brought you the details of this. Nomura essentially has raised the target price to 485, is another stock that is doing particularly well in trade today. The SME story, which we spoke about at the start today, that is Insulation Energy, the arm that is won an order. It's down about 1%, but still it's a stock that is at 1700 and it's quite the success story. Transformers and rectifiers, we spoke to the management. It's quite a significant update for them, and that is reflective in the stock price. In case you missed it, we're talking about the withdrawal of the stop deal from Getco, which is very major from the perspective of the execution of their orders, both in the fourth quarter as well as heading into the next financial year. JFS, Geo Financial Services, it's been on a tear in 2024. It continues to rise even higher, up as much as 3.5%. The signing on the dotted line of that 50-50 joint venture with BlackRock has now gotten done. This is something that was announced, remember, last year. We'll have to see what plays out in the space. They're looked at as a disruptor, and we'll see what they have to do. But Niraj, that's the long and short of it in terms of the stocks. Of course, there are more, I'm sure, to talk about.
I just want to pull up Sun Pharma Advanced Research, and not just today's move, but maybe the last 10 days or the last 1 month move. Sun Pharma Advanced Research is down 5% yet again today. And just look at what the stock has done in the last maybe 7-8 trading sessions. It's just been, there has been a one-way move for Spark, unless I'm very wrong, from 420 odd when it was locked on an upper circuit to what it has done. Look at that slide that has come into Sun Pharma Advanced Research. Here's what happens with some binary event stocks, really, and Spark going through that. Aegis Logistics is up 6%, so that's done well. DOMS Industries is up 4%. Castrol, yet again in the green, up about 3%, so watch out for that one. Ramkrishna Forgings got an order yesterday. That stock is up about 3%, so that's doing okay. On the BSE 500, these are the ones that kind of stand out in early morning trade. Okay, let's take in the opening thoughts from our experts. Rajat, to you first. What do you make of the index? I mean, this is a brutal knock that we have right now on the Nifty. Actually, pull up the Nifty. Sorry, just before I get to Rajat Bose, can we just pull up the Nifty? 1.7% lower now, 370. No, sorry. The numbers are a bit fuzzy. It's actually 0.5%, so it's not that bad. Okay, Rajat, sorry, I got it wrong on the screen that I have. But be that as it may, opening thoughts and a word on Kotak Bank. We had to do a very short one. You still constructive there?
See, first of all, the Nifty is testing its 50-day moving average, which is 22,113. It went down to, I think, 22,103 and then bounced back. We need to see whether it gets taken out or not. If it does get taken out, then there will be a lot of problems. Otherwise, you don't need to bother much. But there will be a bounce back because generally 50-day tends to give a bounce back.
Okay, that's a fair point. Talk to us about the breadth, though. It's quite interesting in a market, global market I'm talking about, where the structure seems to be more bearish than bullish. We're talking about an advanced decline ratio that favors the advances at this juncture in the broader markets, showing resilience, showing strength. In fact, the small cap 250 is in the green right now, Rajat.
Generally, if you are asking me, if you look at the S&P 500 there, that was showing a breakdown, real breakdown. Again, the 50-day was decisively taken out yesterday. But here, I tend to think that 50-day is much more resilient here, unless, of course, during the day you see big fall. And Bank Nifty falling below 47,000 would mean that there would be problems. But already the Nifty Junior is resisting further fall. And so is the CNX mid-cap. This one-way traffic on the downside is going to be arrested either today or tomorrow, because in these days, generally, after a 5-day kind of a downswing, you see a bounce back because money is waiting to come in. That money will again be deployed. There is a little bit of fear, but otherwise, I wouldn't really think that everything is really bad unless we see 22,000 mark in the Nifty is decisively taken out by the bears and they sustain it below for at least 3 trading sessions.
That's a fair point. I didn't ask you, Sunny, about your picks. I asked you about individual counters, but in this particular market, what according to you is the strongest fundamental buy?
Personally, I would say that this could be...
Rajat, not you. I'm talking about Sunny. Sunny, I didn't ask you about your individual picks, but on what, according to you, is the strongest screaming fundamental buy, even with potential sideways move on the cards?
I would like to bet my money on auto sector, and one of my top pick here is Mahindra & Mahindra, and the reason is very simple. So basically, with an expectation of a normal monsoon, I am expecting that FY25 we may see a decent uptick in tractor volume. At the same time, sports utility vehicle, SUV, passenger vehicle continue to do well. Robust order book of close to 2.4 lakh vehicle. And the capacity has also increased in the Q4. So we may see a very robust set of numbers from Mahindra & Mahindra for the March quarter, and our fair value for Mahindra & Mahindra is close to 2,350 rupees with an investment horizon of 6 to 12 months.
Okay. Sunny and Rajat, take a moment to thank both of you for joining in today and giving us your thoughts. Really appreciate your time this morning.
Thank you.
That's our experts on the morning show. Well, let's get in our big fundamental voice for the day. Abhay Agarwal, founder at Piper Serica, joins in with his thoughts on the markets. Abhay, good morning and thanks for taking the time out. Are you a bit circumspect about the prospect for risk assets, considering what's happening to bond yields globally, considering what's happening to the dollar index, considering what's happening to the safe haven gold? And there's a city prediction today they might go to 3,000 as well. How are you thinking about all of this?
Yeah, it is. I think, Niraj, everything that you mentioned is kind of pointing clearly towards a global market where investors are in a risk-off mode, and we are seeing it play out. I think the biggest, more than the geopolitical concerns, Niraj, I think the worry is that Fed has not been able to orchestrate a soft landing. And the data that is coming out from the US is pointing towards that retail sales are double, the growth is double of what it was expected to be. Inflation is sticky, and PMI data continues to be strong. Consumption, employment, everything continues to be strong despite the rate hikes. So I think the worry that is developing is that since Fed has failed to orchestrate a soft landing, what will the Fed need to do now? And could it lead to a hard landing? So I think in that environment, and the geopolitical risks, tensions are definitely not helping in that situation. So I think for the moment, the mood clearly has shifted to reducing risk in the portfolios, increasing weightage to large caps, making portfolios more defensive. And I think some of the things that are playing out, like the dollar index itself now is at 106 plus, which is up by 3% in last 30 days. So that is also telling us something, along with the gold prices at an all-time high. This did not happen earlier. This kind of correlation that you see the US dollar index at 106 up 3% and gold simultaneously high. So the price of gold in US in local currencies it is even more higher than what it looks like just in US dollar basis. So I think putting all this together, I don't know how long will this play out, but yeah, the short answer is yes, clearly a risk of mood right now, and I don't know when it will turn.
Abhay, Alex, thanks so much for joining us this morning. I'm curious about, and of course, we're not talking about one particular day, but then I guess this allows me to ask this question. We're talking about cuts across the board, and significant cuts at that, in risk assets, both today and overnight in the US. But the Indian equity markets continuing to show resilience. Does that, as a manager of money, make you a little bit uncomfortable? Because what you said at the start is that clearly there's a risk of play that is going around. There seems to be perhaps too much resilience. Is that okay to say?
Well, Alex, I think the unique thing about the Indian market is that it is still a very small market from a global perspective, and very solid flows from domestic investors continue to keep it buoyant. So I don't think that Indian markets will see a sharp reversal at the broad indices level. There will be sharp corrections in underlying smaller indices. But at the big index level, I don't think we are going to see a sharp correction in line with the global markets till the domestic flows reverse. And I don't see that happening for some time. So I think the Indian markets, because of their peculiarity, are shielded. And I think the only thing that can drive them sharply lower is very aggressive sell-off by FPIs, which is anybody's guess. I'm not an expert there, or a reversal of domestic flows. Now, barring these two things happening, I think the valuations will hold. I don't think we are overpriced, because at 1150 rupees, 25 earnings estimate for Nifty, we are still about below 20x forward. So we're not expensive by historical means. Could there be a correction? Yes, there could be. But I think in India, I'm seeing that over last 6 months, every dip is getting bought into. So not really so worried about Indian markets in the short term, but it will be useful for investors to build defensive stance even in India.
Okay. Abhay, just trying to understand, how are you approaching themes and sectors? Hitherto, global growth export sectors were largely shunned, and largely, I'm using the term, and the belief was that the domestic focused businesses are the ones which will gain the most. We're seeing global PMIs picking up. We're seeing some activity in chemical names, and the managements are saying that maybe there is some traction there. We're seeing some activity in metals, maybe not steel because China real estate demand is muted, but aluminum most certainly, and some others too. Is it time to look at some of the globally exposed sectors, or would you largely keep your portfolio still domestic exposed?
Niraj, I think it's a mix of both. I think the data that we are seeing from China is pointing towards a recovery now. I think clearly a bottom of consumption demand has been made in China. And China has been out of the global market as a consumer for, since post-COVID. So if that large consumption engine starts to come back with looks like early days, then two things will happen, Niraj. One is that the global commodity prices will probably harden from here because the Chinese manufacturing capacity was being used, was continuing to churn out products, and they were being sold in the global markets at a low price, putting pressure on all commodity manufacturers. So I expect that there will be respite for commodity manufacturers as these prices go up, metals especially, and also a respite in agrochemical manufacturers, because again, China was dumping a lot of them in the global markets at a low price, including pearl drugs, pharma. So I think that will help the global markets and global manufacturers who export recover, get some pricing power back, much needed pricing power back, and will show in earnings in the last quarter. Also, I think you will hear positive commentary from these manufacturers getting some pricing power back, and also it will help improve earnings. So I think the valuations will probably improve for these exporters because they have been beaten down quite a lot over the last 2 years, you can say. So I think some valuation respite will also take place. So I think on the global exporters, we are positive. They're not screaming buys, but I think there is positivity around that. Local consumption also, we are seeing value in large FMCG companies that we did not see since post-COVID, because these companies were just not able to come up with a competitive strategy for local brands. But I think they're getting their act together, and if the monsoons hold up, rural demand stays even at where it is, I think we will see better earnings from some of the large cap domestic FMCG companies also.
Interesting. All right. Nifty Bank, incidentally, down about 0.9% right now. I'm curious about what you think, Abhay, about the frontline banks, because even in the conversations that we're having right now, I don't think loan growth is too much of a concern. On the other end, in fact, it is the deposit growth and the slightly worrisome loan to deposit ratios for some very large entities that is the question. And they have not participated in the up move so far, even if we're talking about above 20,000 levels for the Nifty 50, right? So how would you approach the banking space, and would you be a buyer in any of these banks with the outlook of the next year plus?
I think the whole the lending space, let's call it the lending space, which will include large banks, small banks, large NBFCs, small NBFCs, mortgage companies. I think there is a secular change there, and that is driven by the fact that the large banks, that because of their large branch networks, were able to get low deposit funds. The CASA was high for them and very cheap. I think that is challenged now forever, because the depositors are finding other avenues of, without increasing their risk, getting a higher return. So I think for the large banks, that's a challenge, that NIM will be suppressed. And at the same time, the growth in the loan book is the highest in the unsecured part, which is very high cost lending, and that is where the large banks are very, and probably correctly, are hesitant to lend. They want to stay with the secured book as much as possible. So now higher cost of lending and limited loan growth in secured book is going to lead to a compression of NIMs, which we are seeing, a compression of ROAs again, which we are seeing. And I don't think this trend is going to reverse, because it is a very competitive space now, where the smaller banks are offering higher rates to their depositors, and they are making up for it by going down the unsecured lending path. Now, arguably, that can increase the portfolio risk, but as a lender, you need to have a balanced approach. You can't just be a 3% NIM lender forever. So I think the whole playing field has changed. It is right now tilted in favor of smaller banks, fintechs, NBFCs who are willing to do that extra mile for their customers, both borrowers and lenders. So I think it will be interesting to see how the big banks fight back. They have the wherewithal, but I would hold my horses. I would like to see some respite coming back in terms of higher ROAs, higher ROE, higher NIM, lower cost of deposit for these large banks before jumping at any one of them.
NSE. Abhay, just a second, because what we're spotting on the screen is quite interesting. In fact, the market breadth tilted very, very firmly in favor of the advances. I'm looking at the NSE breadth here, and we're talking about close to 1,400 stocks advancing and just about 400 stocks declining. And that's reflective in the broader end of the spectrum, where you have the small cap 250 index, which is up about 0.7%, 0.7% at this juncture. And this is far from what we anticipated would take place at the start today, given the kind of
far
global...
from how it started, Alex.
Yeah, far from how it started as well. Yeah, and that just goes to show you can't really predict a move, let alone 6 months down. You can't definitely understand what's going to happen the next day, right?
Yeah, we're taking some support at the key levels, which is actually heartening to see for sure. And by the way, a lot of stocks. So it's not just the newsmakers, but look at the shipyard stocks. So Cochin Shipyard, Mazagon Docks, both of them have done well for themselves in the open now. So that packet, Garden Reach Shipbuilders, is doing very well. So that defense pack seems to be bouncing back. Some of the power companies were beaten down out of shape, but Inox Wind, Torrent Power, etc. are coming back too. So watch out. There could be some interesting moves here. Actually, Abhay, coming on this shipbuilding defense-related stocks, Mazagon Dock, Cochin Shipyard, Garden Reach Shipbuilders, at the first sign of a stability at the broader end of the spectrum, we've seen these stocks do really well. What's the bull case here? What's the buy case for some of these businesses?
I think, Niraj, the buy case is very simple. It's just that under-penetration of port activity in India. And I was recently, a couple of weeks back, spent a day with one of the port operators, small port operators in India. And the kind of opportunity that, space that exists that he told me about was mind-boggling. It is like what India needs right now with its current capacity is 20x of what is available. That is the kind of port infrastructure that the country can absorb right now. So we are heavily under-invested, under-penetrated as far as ports is concerned. And I'm not even talking about ports that cater only to inland traffic. I mean, that is almost non-existent despite the government's initiatives. So there is a massive long-term opportunity, and that will be captured by players who have the balance sheet strength to pull on with port construction, manage them as very, very good ports with global standards. I think it's a massive opportunity. We're not even, while people get lost in the run-up in some of the stocks in that space, I think we're just scratching the surface. It's a very, very long way to go. It will have its ups and downs because it is cyclical industry. But from where it is right now, I think the ports business in India is just a humongous opportunity for investors who can take a 10-year perspective.
So, Abhay, what has changed about the infrastructure space as you look at it? Because for a lot of people now, infrastructure is not a taboo word. It's not something that they stay away from. Of course, the leverage ratios would have changed quite dramatically in the way these companies do business. But what else from a watcher of these companies has changed in the manner that they do business and also in the black and white on their ledgers?
Yeah, I think I would call this infrastructure 2.0 because we saw this 10 years ago when there was an infrastructure boom, power, telecom, roads. But the problem then was that the way these tenders were given out, they were given out to companies that did not have both of balance sheet strength and execution track record. And I think what happened is that that led to a very large number of unfinished projects, soon after. And a lot of companies went into bankruptcy, NCLT. If you go to NCLT, you will find companies' projects that were launched in infrastructure 1.0. But now what the difference here, Alex, is that this new infrastructure 2.0 is driven by companies that have both the balance sheet strength, so they're not dependent really on government support to complete the projects. And they're getting their financial closures on time, they're building the projects. And then they also have, because of the talent that they have acquired from India and globally, they have the ability to finish these projects and, get them up and running and make money of it. So I think the whole infrastructure space has become a very viable space for them. So that's the big change, Alex, that I'm seeing between what happened 10 years ago and what is happening right now.
So do you find companies constructive in this space? Excuse the pun. Would you buy at this juncture?
We are looking, and we have a couple of stocks in our portfolio that cater to that segment. As I said, we are very cautious that we do not get into a company that does not have the balance sheet strength or is too over leveraged. That's a recipe of disaster. But the good thing is that we are spotting many companies from large groups that are catering to infrastructure segment. So we are bullish on them, and we have a couple of them in the portfolio, and we are constantly looking for more opportunities there.
Abhay, always a pleasure talking to you, and maybe you are the good charm that the market was hoping for, because we've certainly seen a bit of a pickup from there. So thank you for joining in today.
Thank you, Niraj. Thank you, Alex.
Yeah, all right. That's the view from Abhay Agarwal of Piper Serica. Interesting thoughts there. The question only is, can we keep up from this? Because this seems to be a bit of an uptick from the support levels. Yeah. Let's see if this lasts. Mind you, the top gainer on the BSE 500 is less than 6% higher. Similarly for the top loser, of course. So it's not like there's a lot of movement, but in the green, and the market breadth is positive, which is great. I wonder if Advait Infratech is in the green or no. It was up about 5% yesterday, Advait Infratech, and there is possibly a reason for which this might be doing. We should pull up that stock on your screen. It's up 5% yet again. Now, why is it that Advait Infratech is doing so well? We will tell you on the other side of the break, wherein Shalin Sheth from the company joins in to talk about the company's MOU with the Norwegian company for a very specific purpose. Also give us his FY25 outlook for the company. Stay tuned. back with the India Market Open right here on NDTV Profit, and just take a moment to admire the resilience of our markets, if you will, because there is, I mean, it's not a done deal as yet, but 328 advances to 170 odd declines on the NSE 500 is something that you should take heart from. Energy seems to be doing well, 0.4% higher, but that would largely be dominated by what's happening at the large cap end of the market, but good going. Can we get the Nifty contributors list? So we're still down about 0.5% or 0.4% for the Nifty, but clearly ONGC seems to be doing well. At the same time, IT is not. And I think in some sense, the pain for IT might be coming also from what Mindtree is doing. LTI Mindtree is not the top contributor here, but LTI Mindtree is certainly one of the top losers, if not the top loser on the index today, on account of the resignations that have been seen. 2 more resignations, Alex, for LTI Mindtree. And I was just speaking to Rucha about what has been the spate of resignations into LTI Mindtree in the recent past. And, there have been 8 resignations since the merger, which is November 2022. The major ones, 4 people from the global sales team resigned in 2024. Vineet Teredesai, CFO, resigned on 7th March 2024. Venugopal Lambu resigned just after the merger in Jan 23. And we've had 2 people resign right now. So when so many people moving out.
And isn't the chief executive officer also making way? He's nearly done with his term, if I'm not mistaken.
Not sure.
Unless I'm mistaken. Right?
Not sure of that, so I wouldn't want to tell. But we know what's happened already with the 2 resignations that are coming in thus far this morning, that the news flow that is coming. Clearly, the market doesn't like so many changes happening in a company. Usually, mergers are difficult to make work. This has happened. Remember, Sanjay Jalona, of course, the guy who really did amazing success with LTI per se, went out right at the start itself. I mean, and Samina had a lovely conversation with the LTI Mindtree management about what could happen next. But the resignations leave a bit of a...
And we saw that with Wipro, right? Because that, and the stock bore the brunt of those resignations. And of course, much more than what we're talking about for LTI Mindtree. But remember, Wipro, and of course, you've seen the news, there is going to be a change, or there has been a change in the corner office as well for Wipro. It's down about 12%. And we'll only have to see what the commentary is going forward for the new management, right? And what the outlook is going forward. Not too much, I would say, to take from TCS, because like we were saying yesterday, and of course, when the results came, you can't necessarily extrapolate what happened with TCS with the rest of the IT pack, right, Niraj?
Yeah, you can't. Let's wait and watch how that shapes up. But Alex, 7-8 minutes left for the show to end, and we told our viewers before the break that we'll tell you why is it that Advait Infratech, the company, may be active. Now, the reason is it's formed an MOU with a Norwegian-based company, Teco 2030, for developing zero-emission technology for developing PEM hydrogen fuel cells. We believe that could be the reason. Let's ask Shalin Sheth, promoter and MD at Advait Infratech, about what's up at the company. Shalin, good having you. Good morning. Thanks for taking the time out. This is Niraj here. Good morning. We saw this news flow about you doing this MOU with Teco 2030. Tell us about this and other exciting things in your firm. Let's start off with Teco 2030. What is this MOU about? When does it fructify into material, business opportunity for Advait Infratech? And what does Advait Infratech do? Firstly, can you tell us, some of our viewers, about your company as well?
Thank you very much. My company, Advait Infratech, is primarily engaged into providing solutions and products in power transmissions, telecommunications space, wherein we are focusing on manufacturing of the products, taking a wave on domestic manufacturing by finding the import substitutions. We established in 2009, and by 2023 we got listed. Our company has entered into the green hydrogen ecospace in 2022 and 23. So we have been developing products for the green hydrogen segment, and we have finished our first microgrid project recently, and it also got commissioned by just 2 months before. We have got the PLI scheme for manufacturing of electrolyzers up to 100 megawatt per year. And my facility will be starting 50 megawatt by end of the year, and additional 50 megawatt will be starting by 2025. At the same time, we are also working to develop the ecosystems for manufacturing and supply of the fuel cell. So we were in touch with the Norwegian company called Teco 2030. They are pioneers in developing the world's most densiest and compact model of 400 kilowatt of fuel cell. They have already established their facility and manual production is on. They've supplied these products to various maritime applications, various locomotive applications also. So we are excited to take this technology to India. So that's why we have formed the JV. Advait will hold 51% of the JV and Teco 2030 will be holding about 49%. We are looking forward to start the manufacturing primarily with the assembly route by year 2026. And progressively we'll also manufacture the complete fuel cell in India. Our plan is to be ready along with assembly of the complete fuel cell by 2027-28.
Shalin, what are the applications for this fuel cell currently, or have you gotten indications as to what it can be used for?
Our company has already supplied the first fuel cell just 1 year before. That is in Dehradun, Rishikesh. The customer name is THDC. So this is basically converting hydrogen into electricity, and this can be used for the various applications such as stationary application of the power, maybe the locomotive applications. But what we believe that the application into maritime heavy transportation, remote stationary applications where hydrogen need to be converted into power, and those kind of applications will come in our country by year 2024, 25, 26. So we are bullish about these requirements.
Okay, just a follow-up to that. I'm trying to understand the ecosystem because most people think about hydrogen fuel cell technology and look, we understand and we appreciate that this is the cleanest possible because the output of this is electricity and the byproduct is water as I understand it, right? But how often would you have to switch it? Would you have to create an infrastructure to sell these fuel cells? Is it a swapping nature that you would have to create or a supply chain that you would have to create?
See, it is going to happen in a progressive way. So I think our government is doing in a right way. The first is to create the ecosystem to generate the hydrogen. That is the first thing. So they have been working as many as electrolyzer manufacturings are coming into the operations. So it is the first part. And if you are just talking about the fuel cell, which is going to use the hydrogen for the various application, so unless there is a hydrogen availability, transportation availability, storage availability, I think this system may not work. So that's why I'm using the word as an ecosystem where the hydrogen availability is being taken care. And I believe a time will come, maybe in next 2 to 5 years, wherein the availability of hydrogen and the usage through fuel cell will merge at some point of time. And at that point of time, we believe that fuel cell will be a prominent requirement for the market. Even I can see there are various applications of the fuel cell, like the remote power generation requirements, maybe the generation requirement at some islands, maybe where the transmission grid cannot reach. So I think there is enough space.
Got it. Okay, Shalin, just a quick thing on the numbers. I mean, just trying to piece together what would this JV mean for you. So when does business start coming into your numbers because of this JV?
We believe that our primary number will start from this year itself. Because
okay.
Yeah, because working on two requirements, the very the state utilities, wherein they are also excited to procure the first unit from us. So we believe that it will start getting numbers from this year itself.
What are the numbers that we're talking of? I mean, what could the potential business be like, let's say this year and then let's say maybe FY26?
Initially, it will be definitely on a pilot project basis. So we believe that numbers for the year can be about 10 crores.
Okay, 10 crores. But
for
you
FY25?
For FY25, yes.
Yeah. Yeah.
Okay, and then going ahead, when it's completely on stream, I heard you use the number 27, 28. Are there some estimates that you have, Shalin, for what this business could throw up for you?
Our estimates will entirely depend upon the kind of drive that we'll be having from the hydrogen ecosystems. But we believe that our next numbers for the project will be coming from maritime applications, where we have been working with 2 or 3 state agencies and the shipping companies to put these applications. That will happen very soon. So if we are able to crack those numbers, then definitely we'll be able to exceed our plan.
As I understand it, Shalin, and you mentioned you're also in the electrolyzer business, right? So what contribution does that currently have to your top line?
Last year, we did about 10 crores of business into supplying of electrolyzers and fuel cell. This year, we are hoping that we'll be able to get a few pilot projects. Of that, 2 projects are in our hand. So, of course, it will take about 1 or 2 years to get the complete revenue systems to be established for supplying of electrolyzers in our company. Like we also got the PLI scheme, and we are also going to get the push to supply and to manufacture the plant to reaching up to 100 megawatt of capacity. So our plan is to reach up to 100 megawatt of supplying capacity by 2025 September or October. And we believe that it will be able to give good numbers by the time.
Shalin, just one final question. You've done 100 crores of revenues in 23 with a 10 crore PAT. Thus far, till December, you are on track to maybe double those numbers, if I'm not wrong, based on the numbers that I've seen till December. Let's assume you do that. I don't want you to say numbers because you might be in a silent period. I'm just trying to understand, do you anticipate such pace of growth to continue in 25 and 26?
Yes, we have got our traditional business which is going on, and I think we'll be able to continue with a good space for the year 24-25 also. And we are considering our green initiative. That will be separate revenue stream for the year 24-25 and 25-26. So, of course, it will be part of Advait mainstream. We have established a new company called Advait Green Energy Private Limited, which will be focusing on supplying of electrolyzers, green hydrogen projects, and the carbon initiatives. So I think our numbers will be exciting in the time ahead.
Okay. Wish you all the best for that. Thanks so much, Shalin, for joining us and giving us that perspective. Well, on that note, it's a wrap on this leg of India Market Open. While the indices, the large indices are down with IT leading the pack lower, broader markets doing a tad bit better. From Alex, myself, and the team that put this show together, thanks so much for watching. Up next is Talking Point. We'll be joined by ICICI Prudential AMC's Anand Shah. Stay tuned.